What's up, guys? TJ here, and today we're talking all things interest rates and how you can actually get a below market interest rate with today's rates being as high as they are. But before we dive into that, if you are thinking about buying but haven't yet because of interest rates, you've got it all wrong. Go back and watch my video as to why you need to buy right now. Now for interest rates, we've got a couple of strategies for you. Number one is a temporary rate buy down. And what this means is, let's actually look at it right now. The average interest rate, if you just a quick Google search, the average 30-year fixed rate is sitting right around 7%. Now, in order to obtain a lower interest rate, say you're out looking for houses and you find a house that you really like and you can negotiate with the sellers. If you negotiate with the seller to buy down your interest rate, you can negotiate a temporary rate buy down. Or there's other terminology you might have heard thrown around like a 2-1 buy down, a 1-0 buy down, or a 3-2-1 buy down. Essentially what that is the seller is prepaying your interest for you to lower your rates temporarily. For example, a 2-1 buy down. If rates are sitting in the low 7% range, for your first year, your rate's going to be at 5%, second year around the 6% range, third year, and every year after that, it's the 7% range in which you locked at. Now let's say interest rates come down before you can take full advantage of the savings of the temporary buy down. If that's the case, you can refinance and recoup all of the money you did not use in form of a principal reduction, meaning you owe less on your mortgage. And that was just an example of a 2-1 buy down. There are other buy downs like a 3-2-1 buy down where it's 3% lower for the first year, 2% lower for the second, and 1% lower for the third year. Now for your second option to obtain a below market interest rate, and this is a permanent rate buy down. Unlike a temporary rate buy down, a permanent buy down can be paid for by anyone in the party. The seller with seller paid contributions or the buyer from their out-of-pocket funds. The general rule of thumb is, and this is a moving scale, but the general rule of thumb is for every 2% you pay in loan amount, that will lower your interest rate by 1 full percent. What we help you analyze is how long will it take you to recoup your upfront investment with the monthly savings with obtaining that lower interest rate. Now, it's important to note that with a permanent rate buy down, if you refinance, you lose all of those funds, meaning you don't get a refund on that investment you made. So we want to make sure that it does make sense for you to buy down that interest rate. And if rates are on a downward trend, it might not make sense for you to do a permanent buy down. Instead, it might make sense for you to not buy down the interest rate and refinance later. But again, we'll help you analyze that. Cross Country Mortgage actually has a free refinance program. For when you purchase with us, you have up to 3 years to refinance for free. If you have any questions regarding buy downs, whether it's a temporary or permanent, feel free to reach out to me on any of my social media platforms, and I'm more than happy to help out. Now, your second option is seller financing. So seller financing is essentially when the seller of the home becomes the bank. You as the buyer can take over the seller's existing loan and their interest rate. The one caveat with seller financing is, say the property is worth $500,000 and they only owe $300,000 on the loan itself, you need to come in with $200,000 to bridge that gap. So if you have a good chunk of change sitting around, seller financing might be a good route for you until you can refinance to obtain a lower interest rate. Anyways, if you guys have any questions, please comment down below. We'd love to get your feedback. And if you're interested in other things mortgage and real estate, please subscribe and we'll catch you on the next video.